This is why being right is not enough in trading. Last Thursday, my overnight analysis was almost perfectly aligned with what price ended up doing. Before the session even began, I had a clear expectation of where price wanted to go, what liquidity it was likely targeting, and how I wanted to see it deliver during the AM session. And the crazy part is, price did exactly that. The narrative was there, the bias was there, the read on price was there, but I still ended the day down. Why? Because analysis and execution are not the same thing. Let's dive deeper on this. So here you can see the 15-minute chart of my overnight analysis that I posted. At 1800, with the new daily candle opening, price trapped breakout sellers here, but failed to reach the annotated sell side, and then price has worked its way higher, attempting to reach for the minor buy side, and the bodies are showing premium sensitivity, closing beneath the daily bearish order block mean threshold, dark red line here. And if price is able to reach the 15-minute minor buy side, I would like to see the body stay in the lower half of the 15-minute SIBI, annotated in red, 15-minute SIBI, and I want to see the body stay in the lower half of it. And I still anticipate weakness and want to see price gravitate towards Tuesday's low. So in summary, I wanted to see price reach for the minor buy side, stay in the lower half of this 15-minute SIBI, and then break lower going into the AM session. Looking at the chart from a 5-minute perspective, that's exactly what happened. Here in the London session, bodies are staying in the lower half of the 15-minute SIBI, below the lower quadrant even. Engineering buy side liquidity here, breaking lower. And then going into the AM session, we have our Judas swing higher, bodies failing to close in the upper half. 950 to 1010 macro begins here. This candlestick fails to close in the upper half of the 15-minute SIBI. 955 candle opens, breaks lower. Let's look at the 1 minute here. So we had this engineered buy side, very clean equal highs. Here at 950, we can see price reaching for that level, breaks lower. And then with the 5-minute candle closing here at 959, just below the 15-minute SIBI, again shaded in red here. After sweeping the buy side, I wanted to see if price can offer a fill with this 1-minute SIBI, sell side imbalance, buy side inefficiency. And I look to enter short at this 10 o'clock candle, just one tick below this candlestick's high here, forming the inefficiency with a reasonable stop placement at this candlestick's opening price. And I wanted to see a draw lower as per the analysis, targeting the AM session low that had formed at 940. Now, as you can see here, I ended up getting stopped out right away as price reached for this swing high for a stop run. So now looking at this, did I have the wrong idea? Not at all. Price is in a premium and just has swept buy side. We're seeing premium sensitivity at the 15-minute SIBI. I'm executing within the 950 to 1010 macro window. And despite being stopped out here, my narrative is still intact. Price does not spend too much time in the upper half, creates a high, low, higher high, stop run above here, creating this bearish breaker, this down close candle. And after the stop run, and without spending too much time in the upper half of the 15-minute SIBI, price folds lower, forming this 1-minute SIBI here, and utilizing this breaker, which is also in alignment with a portion of that SIBI. If you can take a look there. See that? And seeing that here, I use this inefficiency to enter short once again, because the narrative is still intact. Price displaces beneath the 15-minute SIBI, and I'm still anticipating lower prices. So this is your silver bullet, 10 o'clock to 11 o'clock time window. Using this inefficiency, this fair value gap, I anticipated a run for the 940 low. It's overlapping the low and the lower quadrant of the 15-minute SIBI. You have the 1-minute breaker. You have these up close candles, which is the bearish order block, and price has done its business, running out the stops. So if it's going to be in fact bearish, it should have no reason to come back up above this inefficiency. And as you can see, price showed displacement getting more than 50% of the way from my entry to my terminus target. And seeing this, I moved my stop to break even at this point. Why at this point? Well, can you see what lies at this level? The 930 opening price. So if price is in fact bearish, I do not want to see it have any trouble cutting through the 930 open. And as you can see, the bodies here were respecting that level, unwilling to displace through it at this moment. Retracement, and I get stopped out at break even. Ending the day being down from the first execution and then break even on the second execution. As you can see here, the narrative was still intact. Price made the run to the level that I was anticipating, but I unfortunately had anticipated a more cleaner run than what price wanted to offer That was the human error for this particular transaction. So the issue was not that the idea was wrong. The issue was that my execution did not give the trade enough room to develop. And this is something a lot of traders struggle to accept. You can know exactly what price is likely to do and still be on the losing side if your entry is too early, if your stop is too tight, or if you mismanage the trade. None of that invalidates the narrative. It just exposes the gap between your analysis and your execution. And that gap is where most traders lose money. Being right is only one part of trading. Being consistent in your analysis and your execution requires timing, patience, and good trade management. Because in this game, precision in your analysis means nothing if your execution cannot survive the path price takes to get there. And remember, a single transaction, a single day of trading does not define you as a trader. Days like this are inevitable. No matter how far you grow as a trader, you're still going to have days where your read is clean, your narrative is right, and you still walk away red. That is part of the game. But what separates consistent traders from everyone else is not avoiding those days completely, but it is how they respond after them. Do you spiral? Do you revenge trade? Do you abandon the model? Or do you review the execution, accept the lesson, and come back the next day with the same discipline? Because consistency is not built by never having losing days. Consistency is built by managing yourself correctly when those days happen. Don't focus on the outcome, focus on the process, and stay disciplined. Now, one last technical thing before I close this here. Had I simply looked at the 5-minute chart, that same execution, look how much simpler things get. What do you see here? The bodies are respecting this 5-minute SIBI, unwilling to lay any body in the 15-minute SIBI after displacing through it. Perhaps if I had executed on the 5-minute chart, I would have managed my trade a bit more differently. First of all, the SIBI would have formed after 10:15, so my entry would have been here at the retracement. And you can see how much cleaner this looks despite having all these wicks and period of consolidation. Just the signatures and price action on the 5-minute chart are much more neater. This ties into the lesson from a couple of the previous videos where simply scaling to a slightly higher time frame can really help clear up the picture. I hope this was all helpful. If it was, please leave a like and comment below. Thank you guys for watching, and I'll see you next time.